Guys, the stock market might actually rally this week, and I know a lot of people don't like to hear that, especially when there's been so much carnage in the markets with SOFI stock as well as pretty much any other stock. Point me out a stock that is not in the commodity space, oil or natural gas, that has not been going down dramatically. I don't think there's one stock out there unless it is just random momentum running stocks. Now, I don't want to waste time with the intro. Do what you guys got to do. Like the video, subscribe to the channel if that is what you want to do. But I want to get straight into the facts on exactly why I am saying this, because I don't want to lead you guys on and not give you guys the facts up front. So the first thing that I want to start with is the put to call ratio. The put to call ratio is currently at 1.51 for the overall index. Now, a neutral sentiment would be about 0.7. So we are double that. So essentially, for every one call that is placed on the markets, there is two puts that are placed on the markets. And if you guys are unfamiliar about how gamma squeezes work or reverse gamma squeezes, essentially if a lot of people start to buy call options on any particular security or on just the broad markets, the market makers typically have to go out and buy stock to oblige for those calls, right? For a quick example here, and we're going to use SOFI. If you're buying $8 calls on SOFI and the stock is trading at $7.80 per share, well, the market makers pretty much have to go out almost instantly and buy stock on the open markets, and that pushes up the price of the stock. The more people that do that, the higher the stock can go, and a lot of the big runners you'll see, it usually comes down to the option activity unless there is a low flow on that particular security. Well, it works the same way in reverse. Say SOFI is trading at $7 per share. Somebody goes out and buys a $7 put. Well, pretty much instantly, the market makers have to go out and short the stock in order to oblige for those put options. That's a quick synopsis. You could get into more nuanced details there, but that's basically how it works. So when there's so many more puts that are placed on the markets or on all of these different securities that keep going down in a very dramatic fashion, then you do see a lot of shorting activity happening on the overall markets. Now, we already went over what the index put to call ratio is. Now, I want to read this to you guys, and then we're going to get into some other things. It says, is put to call ratio a good indicator? One of the most reliable indicators of future market direction is a contrarian sentiment measure known as the put to call options volume ratio. On balance, option buyers lose about 90% of the time. As often happens when the market gets too bullish or too bearish, conditions become ripe for a reversal. So if you guys are unaware, the Nasdaq has already fallen 23% year to date, basically solely off of concerns about growth slowing down, which is granted. I mean, we know that growth is going to slow down to a certain extent, but 23% in just the first 5 months of the year. At this pace, we're going to be down 40% on the year if it continues at this current pace. Now, in my opinion, mixing these factors together here, you're really primed to see a rally. And if we just look at simple technicals on the S&P 500 and pull up my favorite indicators, the moving averages, the Bollinger Bands, as well as the MACD, you can see the MACD is extremely bearish, and it's been extremely bearish for a very long time now, since April 7th. So exactly 1 month today, the MACD went bearish and has been extremely bearish ever since that. The only other time it was actually more bearish was right here during that first initial drop to start the year. But this drop has been a lot more volatile, a lot more back and forth, but it's been trending down a lot longer. So the MACD is primed for a reversal. Let's pull up the RSI as well. RSI extremely oversold. Neutral is 50. We are at 39.08. So again, due for a major bounce. Now the Bollinger Bands. This is essentially 2 standard deviations away from the price of this stock. When there is less volatility, the Bollinger Bands tend to be more narrow. When there is a lot of volatility, the Bollinger Bands are wide, right? These green bands, they're wide. The 20-day simple moving average is this blue line in between. Now, over time, the markets always tend to revert back to the 20-day simple moving average. That is currently sitting at $429.27 per share on the S&P 500, which does show the disconnect here. In other words, we should, in theory, head back close to the 20-day simple moving average here in the next coming days and coming weeks. As you can see, it's a little bit messy, but you pretty much stay around the 20-day simple moving average most of the time. You could get those disconnects here every now and again, but you tend to come back to that level. Now, on the other hand, we just got a lot of uncertainty taken off the table. The Fed meeting was one of the most uncertain events that we have seen certainly this year. We didn't know what the Fed was exactly going to do. We have been concerned about the balance sheet reduction as well as the Fed raising rates. The Fed gave us exactly the game plan, what to expect. 2 0.5% rate hikes back to back. We get that. The markets rallied when the Fed actually said, hey, we're not going to do a 75 basis point rate hike. We're not even considering that. The Fed has said that before, so only time will tell if they actually do that. But hey, we got certainty. We know what to expect for at least the next 2 Fed meetings, and the balance sheet was actually a very bullish thing. Heading into the Fed meeting, we expected the balance sheet potentially to start being reduced by about $95 billion per month starting now. While the Fed said starting June 1st, they're only going to reduce the balance sheet by $40 billion per month. That was also a very bullish thing for the markets, and then starting in September, we're going to get what we expected, that $75 billion reduction to the balance sheet per month after that. So the first 3 months, it's going to be about half of what we expected, and then after that, it's going to be exactly what we expected. So that is a very positive thing, because after all, the balance sheet reduction is like the most uncertain thing that we could ever have, right? Even Fed Jerome Powell during the press conference said nobody really knows what to expect when you reduce the balance sheet. When you reduce the balance sheet, you essentially have to go out and sell bonds, or at least you're not buying as many bonds, and that drives up the 10-year treasury. That is why TLT has been straight falling. This is a very historical drop, and TLT is the 20-year treasury bond ETF, so it tracks the bond market. This was a rush to safety during 2020, during the crash, because when people are very, very uncertain, they don't know what is going to happen, there's a lot of fear, people want safe assets. And what is the safer than U.S. government bond? There's nothing that is safer than that. So that's why you got this huge run up, huge spike in 2020, came down and stayed elevated for a very long time. Now, for comparison here, we have seen a bigger drop now than what we've seen during a 100-year pandemic. So in other words, there is more negativity and uncertainty for the overall economy now than there even was in 2020. And if we just pull up TLT on a 15-minute candlestick chart, you can see the day after the Fed meeting, the bond market sold off about 3.5%. On Friday, the bond market sold off another 1.5% and down 0.17% here in after hours, hitting multi-year lows. The bond market, for comparison, is about 9 times larger than the stock market, believe it or not. So when bonds move this dramatically, it affects the stock market in a very big way. Now, you might be asking yourself, why are bonds selling off? Why do investors not want a 3.14% current yield on a 10-year treasury bond? Well, it comes down to inflation and the Fed. The markets are basically saying they disagree with the Fed. They do not think inflation will come down in a meaningful way, and they think the Fed is going to push us into a very deep recession. For comparison here, if you think inflation is going to be 5% every year for the next 5 years, then why would you buy a 10-year bond that yields you 3.14%? You would sell that bond, you would wait for a later price that would yield you a much better rate of return. So when bond markets sell off like this, it pushes everything down. It usually pushes up oil and it pushes down the stock market. Well, you could see this is a very parabolic rally. And this is basically pricing like your worst case scenario here. This is pricing a recession. Like, the bond market is pricing in a 100% chance of a recession here in the next year or two, right? By the end of 2023, everyone thinks there's going to be a recession, which I think there can be a shallow recession, but this is pricing in a very large recession, and it's really based off of the volatility and the velocity that we have really seen in the bond market. Like I said, it's pretty much parabolic. Pull up a 5-year chart of the bonds, and you're rising faster than really anything you've ever seen in history. You really have to go back to the 80s to see bond rates going up this dramatically, this fast. And even then, I mean, it's pretty comparable on the time frame that we are currently looking at. So nothing in recent history has ever looked anything like this. That's why we're seeing the biggest stock market sell-off that we have seen since the 70s. It all comes back to the bond market. Now, what will cause the bond market, bond investors, to take a breather here, potentially start to buy bonds? Well, like I said, it comes down to the Fed and inflation. Inflation and the Fed, they're obviously two very different things, but they go together like anything else. I was trying to make a food analogy there, but I couldn't quite come up with something on the fly. It's like chips and dip, right? It's just not the same without them. Or it's like a salad without sauce, or with sauce, right? You need the two together. Well, when CPI potentially coming this Wednesday comes down again, core CPI for the third straight month in a row, that could be the breather the bond markets need to finally start to buy bonds again. And core CPI is CPI minus food and energy. Food and energy, the Fed cannot control, so I don't think markets are going to pay too much attention to the headline numbers. It's really going to be the core CPI numbers. And that comes out at 8:30 in the morning on Wednesday, May 11th. That is why I do think the markets will see a bit of a relief rally this week. It's based off the bond markets and CPI data. CPI, as you can see, is expected to come out. Let's go ahead and pull this up. I believe it's one of the main headlines on CNBC. It says inflation is expected to come out at 8.5. At about 8.2% year over year. The last reading was 8.5% year over year. And it says rates will remain an important factor for the stock market, and strategists say the course of the benchmark 10-year yield could determine the stock market's next moves. Basically, what I just said to you guys. So if inflation comes in better than expected, or even on expectation, showing another straight month of decline for core CPI, that should give us room to rally in the markets. Now, things are not all peachy and fine, right? Growth is slowing down, and it likely will slow down, and it wouldn't surprise me to see a slight recession, a paper recession. Now, I will say, like I said earlier, a lot of the uncertainties are gone. We know what the Fed is going to do, and we also just got the largest stocks that have reported earnings, and by and large, they were very good, right? Microsoft, very good. Facebook was better than expected. They were still bad, but better than expected, right? Google earnings were great. Amazon earnings, not so great. Tesla earnings were a blowout. So the largest companies in the world did okay. So the problem here with the markets, and really what is concerning, if you want to point to something that is concerning here, is that investors expect growth to slow down. Investors expect inflation to be high. Now, when you're thinking about how to value a company and you're saying growth could slow down 5%, or just throw a random number out there, well, how do you value these companies if you expect their growth to slow down? Do you value them higher or lower, especially when inflation is as high? You just don't know where to value them. So there's not a lot of price stability here. So once a good factor comes in, like another CPI reading that is coming in even lower, potentially affecting the Fed's decision to potentially not raise rates as aggressively, that's where you could get a balancing out to at least valuations, or even, allow for future valuation expectations to go up, meaning you could allow the stock market to go up momentarily. Now, I will say, when the stock market does finally crash, it's going to be because of earnings, right? A recession as well as earnings slowing down. And it's going to be another 3 months before we get new earnings again. And that is going to be the real test. Earnings season, especially when you're this concentrated in the markets, when Apple controls 7% of the S&P, 10% of the NASDAQ, when Microsoft controls 5% of the S&P, 7% of the NASDAQ, if those two stocks alone report bad earnings, and you get an Amazon with bad earnings, Tesla with not so great earnings, or Google with not earnings, right? Not good earnings. That's where you can see a lot of pain and a lot of trouble for the stock market. It's, in my opinion, not right now. Earnings were just not bad enough. So when you mix all of this together, the bearish sentiment, potentially a very good catalyst this week, the bond markets that have went parabolic that need to relax a little bit, the fact that we just got the large tech earnings out of the way that control a majority of the markets, I don't really see too much downside left from here in the short term. And that's very key, in the short term. Now, if we go ahead and clean this up a little bit, and go ahead and take everything off here, you can see that we flushed out twice in the past 2 weeks, down to 405 2 days in a row, and the markets have rebounded as soon as we hit those levels. So algorithms obviously want to keep the markets above 405. You could even say we've seen a couple flush outs now, right here, 1, 2, 3, 4. So effectively, if you just consider the last 3 right here, 1, 2, 3, you're pretty much at a triple bottom when you're talking about the 410 level. And when you do get a triple bottom, let's just go ahead and pull this up. It says a triple bottom is a bullish chart pattern used in technical analysis that's characterized by 3 equal lows followed by a breakout above the resistance level. So just textbook technicals here. Triple bottom usually leads to a bounce. And that resistance level could be, you know, that 425 level or potentially the 430 level. That's really what I would target by the end of this week if CPI is actually good. It would not surprise me to see a 2 to 3% positive day. Now, obviously, I'm not a fortune teller. I don't know exactly what will happen. This is just using my market experience, pricing experience mixed in with potentially good catalysts to come up with this claim and this conclusion. So hopefully this provided you guys some context to, why potentially we could see a market bounce. Let me know what you guys think about this down below in the comment section. Source your comments, questions, or concerns. Like the video, subscribe to the channel if you guys found value out of this video. I hope you guys enjoy your weekend. Happy Mother's Day, especially to all the mothers out there. Fathers, I'm also a father. Our day is coming, baby. So you guys enjoy your weekend, and I will see you in the next one.